I've heard you talk about you're not just investing in the companies, but you're investing in the countries.
There are some businesses that are inherently local. So retail banking, for example, you're investing in the country's growth prospects because the company is based there. You're also investing in the rules and legal infrastructure of that country. What the society values and expects from the companies is different. Therefore, where a company is domiciled does actually matter.
Share with us a lesson you've learned.
I actually think one of the key things in our business is never to.
Today, we're joined by Samir Parekh. Samir is a portfolio manager based in London. He's been at Capital Group for 18 years. Super happy to have you on, Samir. Thank you for joining.
Thanks for having me, Mike. I'm excited.
London is my favorite city in the world. Tell me a little bit about why you like London.
Well, it's been home for us for 25 years. Our kids are born there. They think of themselves as British, so they're pretty much London is home. But in particular, I think for me, what stands out in London, it really is a cosmopolitan city. So you could be from anywhere and still feel like London belongs to you. You're not forced to become English or British. And that makes it a very exciting city for me. And then I love watching cricket, and you get that in London.
Yeah.
So that helps.
Good. You got involved in this business, and a lot of folks who were involved in it, something had to do with their parents. And your father was an accountant. So talk a little bit about how that worked and how that got you involved in the investing business.
That's right. So my father was a tax accountant, but he did invest on the side. And I was 16 or 17 when I kind of got exposed to investing. And that got me hooked. So it was all, my career really is because of that initial exposure to investing. And this was India when it was opening up. So it was a fantastic experience. But that's why I'm in the business.
So we have 5 core values at Capital Group. One is diverse perspectives. You do have a diverse perspective. Before you moved to London, you worked in our Mumbai office. How does that factor into your investment strategy or philosophy today? And
so my experience with Capital in Mumbai office was actually my second stint working in India. I first worked in India back in late 90s, and then I joined Capital 2006, and then I went out to Mumbai office when our Mumbai office was open to be there for a couple of years. But growing up in India was a great lesson in several things. Particularly in Mumbai, as anybody who's been to Mumbai knows, it's noisy, it's messy. But if you want to get somewhere, you got to focus on where you're going and kind of blind out the noise. And I think that was a big lesson with what investing this day feels like, because there's so much noise in the system. The other thing growing up in India helped me understand was countries can change. I mean, I was a part of a cohort where I was old enough to know what the country was like before India liberalized. And at that point, you had to literally get a license from the government if you wanted to do anything. If you wanted to make steel, you had to go to the government. You wanted to import something, you had to go to the government.
very bureaucratic.
Very bureaucratic, very license orientated. And then in 91, they changed the rules. And then it took probably next 10 years for the country and the businesses to adapt to the change in rules. So that experience was foundational in how I invest. And then the third thing was, I got used to volatility of the equity markets. I remember the first year I have memory of the equity market that Mumbai, it was called Bombay then, Bombay Sensex went from 800 to 1400 back to 1000 and then proceeded to go to 4000 over the next several years.
It was incredibly volatile. Yes.
Very volatile. And I kind of therefore have this mental makeup where when things are going fine, I'm worrying about volatility and bear markets. And when volatility happens, I feel like, okay, now's the time to actually get excited. And that's all because of the early experiences back in India.
Well, the volatility of the markets today must be right in your zone then. That's great. So you were a successful analyst and now a successful portfolio manager. So things do go right. What is your investment edge, Samir?
What's my investment edge? I think certainly time horizon is one. I think that's collectively the common thread for a lot of our investors. But I think on top of it, blinding out the noise. I think that's where I kind of think it really helps me. And I think of noise in 2 ways. One is at a point in time when I'm looking at a company, there might be 15 factors. And I boil it down to here are 1 or 2 that really matter. And I don't need to worry about the other 12 or other 15 because then it really helps me dig deep. And the second is over the time of the holding. Because there will be lots of volatility, there'll be lots of news flow, bad quarter, good quarter. and kind of ability to blind out all of that noise is what actually allows me to hold them for a long period of time.
And that can be different on the different companies. What are the most important driving factors for a certain investment thesis or a certain company that you own could be very different than a different company in a different sector in a different country.
Absolutely.
Yeah. So you looked at emerging markets for a while. And one of the factors in emerging markets is a lot of the companies can be family owned. And some of that's good and some of that is challenging. How do you navigate that? How do you think about that?
That's right. I actually think family-owned companies can be great investment opportunities, both in emerging markets and in the developed markets, if you can get a good read of what the family is trying to optimize for. Sometimes the benefit of a family-owned company is you get pretty unified decision making. You don't have many different stakeholders trying to kind of navigate what is right for the company. And if the family representative is involved in the company, then they can actually take the company in a particular direction. If they're capable, that's a great thing. And then lastly, you get a very good alignment of interest in long-term orientation because they're managing the company for intergenerational wealth transfer often.
Right.
What one needs to do there is spend a lot of time thinking about what is the family solving for. Sometimes family is trying to solving for being famous. That may not be the same thing as creating wealth for shareholders. Sometimes the family is trying to solve for purely intergenerational transfer and not for wealth creation, which again may not be aligned with our interests. But where it's aligned with our interests, it's super powerful. What I've done is, in situations where there is family involvement, spend a lot of time with the family to the extent that they are available to speak with us. And because of capital's reputation and reach, generally you do get access to the families. And if you spend time with them trying to understand their motivations, is super powerful.
It's interesting. Someone shared a statistic internally with me the other day and said that our analysts and portfolio managers had 21,000 company meetings last year.
Amazing.
So I had to do the math on it because I'm not that smart. I had to do the math on the calculator. The number of trading days per year is 251, and it came out to be 83 company meetings per trading day that we were doing somewhere in the world. So that insight that you gain from spending time with either a family-run company or not can be super valuable.
Yeah, it's super powerful.
When you talk about emerging market and investing in general, I've heard you talk about you're not just investing in the companies, but you're investing in the countries.
That's right.
So unpack that for us, if you will.
Well, so I think we've gone through a period where there are some global multinationals, and those global multinationals do very well in some businesses. But in my view, there are some businesses that are inherently local. So retail banking, for example, is a very local business. Food retailing is a very local business. Pharmaceuticals is a global business. Tech hardware is a global business. So you have these different kinds of businesses. And when you think about when you're investing in local businesses, you're investing in the country's growth prospects inherently because the company is based there. You're also investing in the rules and legal infrastructure of that country. So, for example, investing in India might provide us some set of security protections. In a different country, it may or may not, and that matters. What the society values and expects from the companies is different. Somebody was saying to me the other day that in Korea, for example, in South Korea, if you're a successful business person, chances are that the government wants to go against you because that's popular, because they're seen as somewhat not great. While in India, I've seen the shift from the socialism where wealth creation wasn't a positive to wealth creation is a positive. And then the society doesn't kind of come against you if you are successful. So that, I think, again, therefore, where a company is domiciled does actually matter.
So if I were to look into your own portfolio today, you have different holdings, and some of them may be these globally competitive companies in these global industries, and then some may be really locally successful companies. Do you think about that in portfolio construction? Do you try to have a certain percentage mix of both, or is it purely bottoms up? Where can you find the best opportunity?
It's mostly bottoms up. Where can I find the best opportunity? But the questions I ask often differ a lot. So, for example, if I was invested in TSMC or Taiwan Semi, which is a globally competitive company based in Taiwan, I do think about Taiwan, but I think much more about their share in the global market and their competitive position relative to everybody else. But if I was investing in a bank in India or a retailer in India, I worry a lot more about what's going on in India and what's the interest rate cycles in India and what's the growth outlook for India and things like that.
So you said when you invest in emerging market companies, you're also investing in the countries. How do you think of the currency? When you buy the currency to buy the stock,
That's
you
right.
have that currency risk. Does that factor a lot or a little into your investment process?
So most of the time, it doesn't play a big role. The only role it plays is I actually pencil out in my mind what's the structural loss that I might take on currency. So for example, for a long period of time, India used to have a 10% inflation. And I used to say, okay, you're going to lose 4% on currency depreciation, because the rest will be made up by inflation differential versus the West, as well as productivity gains. So when I pencil out rupee returns and I say, okay, this is going to be a 15% rupee return, I would say 4% I'm going to lose on currency, I'll get 11.
Oh, that's interesting. So you literally, your return expectation for the actual stock had to be 400 basis points effectively higher because of your currency depreciation.
That's right. But I don't spend a lot of time taking a view whether the rupee is going to go up or down or any other currency is going to go up or down, unless everything I read says this is at the extreme of overvaluation or undervaluation. So I do pay attention to factors that drive
Right.
currency, things like current account deficit, inflation, interest rates, all of that stuff. But I almost never end up making a decision to invest because of
Just
it.
on
So
the currency.
sometimes I might stop myself if I feel like I'm investing in this company in a particular country, but I worry that the currency is very, very overvalued. I might pause.
Is there any type of investment that you just simply avoid, that you say, you know what, I'm not going to spend my time on it. It's not what I do?
There are a couple where I find very difficult, and I find it's okay for me to say I may not do it, partly because other portfolio manager colleagues of mine do it. There are two. One is biotechs or any loss-making companies where they don't have profits. I find it very difficult.
That's generally a good one to avoid.
Well, no, some of those companies end up being great investments, right? Long term. If you have great science and you may not make money early on, you could still invest and it could work. I just find it tougher. And the second one is companies that need to issue more capital to grow. So, for example, real estate investment trusts, they pay out a large part of their earnings in dividends. And then if they want to grow, they typically issuing new units, or companies that are highly acquisitive and they acquire using new equity, because I feel like then you're relying on the markets to be favorable for you to keep doing your strategy. And as I said earlier, I constantly worry that markets may not be favorable 3 months from now.
So you mentioned loss-making companies like biotechs. One of the reasons, and I've asked this of others, that I've heard folks who are not super deep subject matter experts avoid them is the hit rate is so low.
That's right.
So yes, they can be loss-making and then all of a sudden be 5 or 10 baggers over a period of time because they've really found something unique. But the hit rate or the fail rate can be quite high.
That's right. And again, I actually think one of the key things in our business is never to kind of be strictly in your comfort zone. So I actually occasionally do it just to make sure I'm pushing myself outside the comfort zone. And I try and spend time understanding how some of my colleagues who've had much more success at it do it. They actually buy a basket of those companies, and then they feel like one or two of them will pay for the losses in others. So I'm in that phase where I'm actually trying right now. But I'm trying at a much smaller size than my colleagues would.
And I'm sure you're following the analysts.
Completely following the analysts. In general, I tend to follow the analysts. And I think that's probably true for most of us portfolio managers. I would occasionally buy companies where analysts are not ready to buy yet, but they feel like this is a good company, or they can dimension what the risks are, but they're waiting for the perfect timing. I might go ahead and buy ahead of them. But otherwise, I rarely buy a company where the analysts have not done any work on, unless it's the one I covered as an analyst myself.
You did a very nice job when you were an analyst, by the by. Let's get into the mistakes you've made. And I know you'll preface it like everyone that there are too many to count because you're a humble investor, but share with us a lesson you've learned that's helped you get better in your process.
Actually, I think of mistakes, and my mistakes fall in 3 categories. And surprisingly, actually, the last 2 categories I care about more. First one, certainly there was a lesson which I've taken, but I don't let it haunt me. In my early days, one of my first recommendations was an auto parts company in India. And they were setting up plants in India to serve the Indian market, but also acquiring plants in Europe and elsewhere to try and serve the global markets and then try and move some of that manufacturing to India. So the narrative sounded very interesting. We met the management team and we felt like, okay, this is a legitimate company. But it turned out that they were basically using pretty aggressive accounting and such that a lot of costs were actually being capitalized and not coming through the cash flow. So eventually they ended up with a lot of debt and they needed a rescue rights issue. And I think the company almost went bankrupt. So that was a big lesson in kind of doing all the work, not get kind of blown away by the narrative.
By the story,
or what you might kind of, sometimes management teams you meet might be better communicators than operators. So that's
a good point. Might be better communicators than operators. I haven't heard it framed that way. Mm-hmm. They may be great at talking, but not executing.
That's right. That's right.
Yeah, that's interesting.
So that was the first one. And I think the lessons are very obvious. And I do kind of keep that in mind. And now when I look at a company, I start with the financials. I hear the story, all of that, but within the first 5 or 10 minutes, I'm going to the financials. The other two are, one, actually, there's a company called Titan Industries in India, which is a jewelry chain in India. And I invested in it at $1 billion market cap. And I held it till it got to 4, and I felt like, wow, this has been a great investment. I think it got to 4 in a couple of years. It was a phenomenal investment. And then I sold it. I thought it was too expensive. And it's now a 32 billion market cap company.
Okay.
And it's, again, a lesson in how you could get it right and not get it right. And I should have just kept it. So that's the one that I think about all the time because it's relevant. Often there are companies in my portfolio, hopefully, that do well. And then you kind of feel like you should sell it. And then you keep reminding.
Your average holding period.
That's
just
right.
saying, even though it's been successful, the moats it's built around itself are probably deep, and it has pretty good runway.
That's right. That's right. And then the third one is a similar one, but where I've never invested. So there's a company called Asian Paints. I think Winnie Kwan talked about it on the show. And I never invested in it. And I think it's gone up 40x during the time I was an analyst. And every time I met them, I said, this is an amazing company. I didn't invest in it because the valuation was too high. So that's the other thing I keep thinking about.
The ones you missed.
Ones I missed, particularly because I tend to be valuation sensitive. And that has helped me. But also this is the cost of kind of being too valuation sensitive.
So you spent a lot of time on the road, as you mentioned. You visit companies all of the time. Can you pick out a trip that surprised you when you went? You might have thought something going in, but then all of a sudden you're meeting with a certain company or a certain group of companies and you came away with something very different.
Yeah, let's do two actually. So there's one which is more fun and it surprised me about capital culture. So I think I'll talk about that and then I'll talk about one from an investment standpoint. So a group of us were in Delhi. I think it was maybe a couple of years after I joined, and I kind of shepherded a group of about 8 to 10 people to see companies in Delhi.
So early 2000s?
No, late 2000s. Late
2008, 10?
Yeah, something like that,
okay.
Maybe 10 or 11. And then we were in Delhi going from one place to another to see companies. And we were in a bus and the bus breaks down. And we were like, okay, the bunch of 8 or 10 people, we're trying to go see a CEO and a founder of a company, and we're not going to make it in time. And then some of the experienced people said, there's small 3-wheeler rickshaws around. Why don't we just hop into them? And we'll get there. And I was sitting there thinking, this is very clear. People at Capital don't care about kind of saying we're going to get that in a very nice, luxurious way or whatever. We're going to get there because what counts is finding companies for our shareholders and being at a management meeting on time.
Didn't need the air conditioned bus.
Didn't need the air conditioning bus.
And make the
and it's fine. So that was, I think, great lesson in what really matters to our people. And I think it's super important. The second one was actually a recent trip to see SAP, I think 3 years ago, so just after COVID. There was a group of us, 3 or 4 of us, who went to see SAP in Germany. And SAP had this reputation of a company that was kind of great engineering talent, run for the engineers. They did good products, but never quite converted that to high level of profitability. And that was kind of at least my ongoing hypothesis. And the analysts were saying, no, it's changing. This is a new management team. Something's different. Let's go see them. And we did. And we spent the whole day meeting 4 or 5 different executives from SAP. And we came back thinking this is different. They are taking profitability much more seriously. They are cutting costs where it's excessive. They while continuing to invest in product development. So they're not doing it in a way that's going to harm the long-term future of the company. And then we came back and made it a very large hold. I think all of us made it very significant holdings in our portfolio. At a point, it was one of my largest holdings. So that was a great research trip that was very productive and impactful for the portfolios.
Yeah, it shows why kicking the tires and being present and being live in their offices makes a difference.
Hugely helpful.
Yeah, I think there's too much of an over-reliance on we can do it over a Zoom or WebEx call as opposed to being in the office and looking people in the eyes and having that conversation.
That's right.
I'm glad you did that. Let's get into opportunities today. I know you think India has a really bright 5 to 10 year investment future. Why? What is it?
I think you mentioned it on this podcast in a couple of earlier episodes. The median age is very low.
Median age. The median age, I think, is 29 years old.
And so that certainly helps. I think the country has gone from what was a socialist kind of mindset, this is going back before 91, to a lot of entrepreneurs and entrepreneurs being seen as heroes, entrepreneurs who are contributing to actually development of the country. So I think that, again, is super helpful. Stable politics in large part, and that has helped as well. And in general, it's the entrepreneurs and the wealth creation that is creating opportunities for us as investors. The other thing that India has done very well is they manage their economic outlook so that the inflation's been under control. For the first 30, 40 years of my life, inflation in India averaged 10%. For the last 10, it has averaged around 5%. And that has a huge difference in terms of how much currency depreciation we should expect.
Absolutely.
And therefore returns for us. But also locally, what kind of interest rate environments they can run, what kind of stability they can provide to local businesses. So I think India is a huge land of opportunity from our standpoint.
Yeah, I think that transformation in that market from what it was 25 years ago to today is incredible. So the next 5 to 10 years should be a really interesting environment there. Outside of India, what do you like?
Outside of India, one big area that I've had investments in over the last 3 or 4 years, and that has worked out, but I continue to think they will be attractive, are European banks. Before I came to Capital, I used to be a banks analyst, but I also covered other sectors. So this isn't just purely because of that. But European banks, post the global financial crisis, were left for the dead. They got over-regulated. The return on equity went down to single digits, and the regulator wanted them to keep increasing the level of equity that they were holding, which means they did not have ability to return any kind of returns to shareholders. And what happened post GFC was they had this negative interest rate environments. And if you think about banks, they have two businesses. There's the deposit taking business and there's the lending business. The deposit taking business is where you and I and others getting a monthly paycheck and leaving it in the bank, getting nothing for it. In a normal environment, the banks can use that money to lend out to businesses. But if others can borrow from the central bank at negative interest rates, i.e. they get paid to borrow, having this deposit bases were not valuable. So post GFC for 15 years, the banks were, their profitability was impaired. They're asked to keep raising more and more capital. And then they had other kind of regulatory costs.
Yeah, they became low returning utilities.
That's right. Yeah. And a lot of people thought it was permanent. But when we started seeing the inflation spike post-COVID, I was of the view that this inflation will persist for a prolonged period of time. The central bank will keep rates in the 2 to 4% range. And if they do, then banks will make double-digit ROEs, which they are making. And when we started investing, they were trading at 0.7 times book value or 5 or 6 times earnings. Now they're trading at 8 times earnings and at book value, when they're handily earning over the cost of equity and buying back shares or returning us dividends. So I think this is very attractive.
And the European banks, I'm guessing, will be beneficiaries of the fiscal stimulus we're seeing in Europe on the back of tariffs.
Certainly. So I think European banks are interesting. The other area that I think is interesting and not spoken about as much is Japan. Japan, I think, went through a 40-year period trying to get out of deflation and couldn't. And in some ways, the post-COVID inflation spike, even though it came externally, helped Japan. So wage growth in Japan is now 3 or 4% and seems to be structural. And that is helping Japan get out of deflation. And that, I think, has huge opportunities for us as investors as kind of the economy starts learning to deal with reasonable inflation, which is actually what's healthy for the equity markets.
Well, also in Japan, and we talked about management teams, but the focus now on creating shareholder value, that's a laser focus that didn't exist
That's right.
10 and 20 years ago.
That's right. When I first started going to Japan as a portfolio manager, I met small cap companies and they didn't really care about ROEs. And now almost every company has ROE as a part of the presentation. And interestingly, it's all homegrown. It came from the Tokyo Stock Exchange asking the board of directors to say, tell us if your stock price is trading below book value, tell us what you're doing about it.
Right.
Which has created this wave of focus on ROE and shareholder return, which never existed. So you're right, that helps us a lot.
I was seeing some clients in Korea last year, and the conversation was about that. It's looking at Japan, looking at the focus of shareholder value and saying, how do we do the same thing to make it front and center? So I think that's being exported in some ways to some other
To some
countries.
extent it is. And in fact, I have some investments in Korea on that basis, but it seems early days in Korea. And they're going through a political, it's likely that they might go in the same direction as Japan has, but we need to watch it.
Still.
Yes, it's early still.
Days. All right, we're going to finish up with a couple personal things about you. I'm going to look into your London office, and you have in your office, and I'm going to describe it for folks who are listening, it's a miniature size or a smaller size cricket bat that's signed by a bunch of folks.
That's right.
So I'm going to ask you to talk about it while I hand you this lovely bat. And I know you have a passion for cricket. And I know in March of this year, India won the ICC Champions Trophy, which is a big deal. So maybe describe the bat, why it's in your office, your passion around cricket, and how big of a deal that championship was.
Well, the championship was important, but let's talk about the bat first. The bat is special because it's signed by a group of my colleagues. As you know, I changed groups within Capital. And when I was changing groups, the group that I moved from gave this bat as a gift to me, and everybody who was there signed it. And I feel like the reason I'm the kind of investor I am is because my colleagues have helped me kind of learn over time, and they continue to help me. So this is a good way of capturing kind of their best wishes, and I kind of keep that on the desk to remind me of my formative years at Capital. More importantly, it has a signature from Claudia Huntington, who I kind of regard as my greatest mentor at Capital. And that's special because she's retired. So
she was here for about 40 years. I think she retired maybe 5 years ago.
That's right. So she's no longer here, but having this there reminds me of kind of everything I've learned from her.
I will tell you what I lived in Australia in 1993. I was teaching and coaching, and the kids they said, you have to try out cricket. And I, obviously very familiar with baseball, not so much with cricket. And one of the kids bowled to me, and I gained a huge appreciation for how difficult it was, because I tried to hit the ball and it did the spin where when I tried to hit it, it was no longer there. And I said, I think I'll stick with baseball.
That's the reason I only watch it. I don't play it.
All right. Well, thank you for sharing that. We'll end with what you're grateful for. I'm going to share with you your mug that will send you back to London. We won't ask you to carry this in your carry-on. But here's our Capital Ideas Obsessively Grateful mug.
Thank you.
And Samir, and by the way, I think this conversation has been fantastic. So I'm grateful that you did it and were willing to do it. But
I appreciate you saying it.
It's fun conversation. But what are you grateful for?
Well, I'm grateful for two things. So professionally and personally. Professionally, I'm just grateful for my colleagues, the analysts, the portfolio managers. I can't be the kind of investor I am without getting the constant inputs from them that I get. More importantly, I would not have learned to be the kind of portfolio manager I am had I not learned from other people's wisdom and advice and all of that stuff. I think one of the things we have at Capital is this culture of sharing your learnings, sharing your mistakes. And that's so powerful when you're new to this business to learn from. So I'm grateful to my colleagues for being very generous, sharing everything they do. Personally, I'm grateful to my dad for getting me into this business. Sadly, he passed away last year. And then I'm grateful to my wife and my kids. As you know, this job is all-encompassing job. It's 24/7. And they've kind of coped with that. They've recognized that investing is a passion for me, and they've kind of coped with me focusing on it quite a bit. So I'm grateful to have a family that supported my passion.
Well, we'll leave it there. That's incredibly well said. So thank you. Thank you again for joining us. Thank you for investing our clients' assets with such passion and helping to lead in our London office. And just thanks for being a great person, because you really are. So
Thank you, Mike.
I'm super happy to have you here. Thank you all for joining us, and we look forward to seeing you on the next episode. Have a great day.